Most traders believe that if they find the right strategy, indicator, or setup, their results will finally improve. They spend months switching methods, changing charts, and looking for confirmation, but their results stay inconsistent. What they often ignore is that the same person is making every decision with the same emotions, habits, and reactions. When real money is involved, fear of losing, greed for more profit, and the pressure to be right start affecting decisions. That is why two traders can use the same strategy and still get very different results. The real difference is not the strategy, but how the mind reacts to risk, uncertainty, and emotional pressure. At its core, trading is not only a technical skill, it is a psychological one. Every trade is a decision made in an uncertain environment. Outcomes are never guaranteed, and losses are a normal part of trading. Trading psychology means how you think, feel, and behave before, during, and after a trade. It affects whether you follow your plan, manage risk properly, accept losses calmly, or react emotionally. In this video, the focus is on why psychological control and disciplined thinking matter more for long-term consistency than any single strategy. This content is for educational purposes only and aims to help you understand the mental side of trading, so you can approach the market with more clarity and balance. Many people see trading as charts and indicators, but in reality, trading is a mental performance activity. When money is involved, emotions naturally appear. The market does not reward effort or intelligence, it reacts to decisions made under uncertainty. A trader may know a strategy very well but still fail to follow it because emotions interfere. Stress, hesitation, and impulsive actions can override logic. This is why most trading problems are mental, not technical. Understanding this is the first step toward better trading behavior. A strategy is only a framework. Results depend on how well it is executed. Many traders know their rules but fail to follow them when emotions take over. Entering late, exiting early, or skipping good trades are execution problems, not strategy problems. Psychology controls execution. Under pressure, the mind looks for comfort and quick relief. When execution becomes emotional, even a good strategy stops working. Consistency comes from improving behavior, not constantly changing strategies. Fear is one of the strongest emotions in trading. There is fear of losing money, fear of being wrong, and fear of missing opportunities. Fear causes traders to close trades too early, avoid good setups, or hesitate when action is needed. When fear controls decisions, clear thinking disappears. A strategy only works when it is followed with patience and discipline. Fear cannot be removed completely, but it can be understood and managed. Awareness is the key. While fear stops traders, greed pushes them too far. After a few winning trades, overconfidence often appears. Traders may increase risk, take too many trades, or ignore rules. Greed creates a false sense of control in an uncertain market. This usually leads to mistakes. Long-term consistency requires emotional balance, not emotional highs. Psychology helps traders stay grounded during both wins and losses. Many traders experience the same emotional cycle: confidence, then overconfidence, then loss, followed by frustration and impulsive decisions. This cycle repeats when traders react emotionally instead of thinking clearly. Strategies do not cause this cycle, behavior does. The market often exposes emotional patterns. When traders become aware of these patterns, they can pause and avoid repeating the same mistakes. Discipline does not mean being perfect. It means being consistent. Discipline helps traders follow the same process in every situation, no matter the result. Losses are part of trading and should be accepted calmly. Without discipline, even proven strategies fail over time. Psychology supports discipline by helping traders control emotional impulses. Consistency is built by repeating correct behavior, not by chasing big wins. Professional traders focus on the process, not individual results. Each trade is just one event in a long series. Losses are seen as part of the business, not personal failures. This mindset reduces emotional stress and improves decision. Professionals do not try to control the market. They focus on controlling their own reactions. This psychological approach is what creates long-term stability. Learning strategies is important, but before that, traders must develop self-control, emotional awareness, and discipline. A stable mindset allows even simple strategies to work well. Trading success does not come from complexity, but from consistent behavior. Improving psychology strengthens every strategy. This is why psychology comes before strategy. It shapes every decision you make. Trading improvement does not come from constantly searching for new strategies. It comes from understanding how you think and react under pressure. The market will always be uncertain, and losses will always be possible. What you can control is your behavior, your discipline, emotional stability, and decision. Without working on psychology, no strategy can deliver long-term consistency. Focus on self-awareness and mental control before focusing on strategy. Treat every trade as a learning experience, not an emotional judgment. This channel exists only for education and understanding. If this video helped you see trading differently, consider subscribing and continuing this learning journey.